Markets down today in part because investors worried about a rate hike coming up real soon. We're getting really close to some new clues. We'll get them from the Fed at 2 p.m. Eastern. But first, market watcher Bob Wiedemer on if rate hikes would really kill this rally. Bob, we had one rate hike. It was in December. We kicked off this year with a horrendous start. Why do they have such an impact on stock market rallies?
Well, let's take a look. Right now, we're having a rally that seems pretty bulletproof, to be honest. We didn't really have a rally going to the last rate hike, so I'm not sure they're exactly comparable. But interest rate hikes are a big deal because people think that that's what's going to be going in the future. If you do one rate hike, it's going to be followed by more and more. And I don't think they're going to do it, partly because it does have a big impact on the stock market, and I think it will still have a big impact. But again, this rally's been pretty bulletproof for the last month or so. Bad news hasn't affected it. But
there was a period this year I felt the Fed had properly articulated a potential rate hike, and it felt to me the market was getting comfortable with it. It was being telegraphed. They were being, it felt like it was pretty good. And maybe that's the question here, because 25 basis points, I don't see how that changes anything, and certainly we don't have there's not a mad dash for people to refi their homes or anything like that.
25 basis points doesn't change anything. You're absolutely right, Charles. And that's what's sort of funny about all of this talk is, I mean, it's been years of talk about what's basically been a 25 basis point increase. But it did have a big impact in January. I think fundamentally the market's just not that, it's fragile, partly because the recovery, or I should say the economy recently has been fragile. World economy has been somewhat fragile. Brexit, which is what's driven this current rally, is really bad news, or it certainly isn't good news, but it's driven the rally. It's a funny market, but I think it's a little more fragile than it might first appear, and I think that's why interest rate increases will still have some impact, even if what you're saying I think is true. It seemed like the market was a little more willing to take it earlier, but...
Yeah, Bob, a lot of people have problems with central banks in general, and a lot of people who've missed this rally or just more or less dying-to-wool bears are saying the only reason the stock market is up is because central banks have been accommodative. We know the Bank of Japan does go out and they do buy stocks through ETFs. They do buy equities. Our Fed doesn't do that, but they have enabled corporate America to buy back stocks, billions of dollars worth. So how much of a percentage of the success of this rally would you put on central banks, or how much of it was that perhaps we were oversold going back to 2009?
I'm going to say most of it was due to central banks. So I think that's really what's driven this market. It may seem like now, because we've had this little post-Brexit bump of 6-7%, that, oh, well, we're free of central bank stimulus. No, as you say, all around the world, there's central bank stimulus. It's very easy for us to come back and do more, and we're obviously keeping interest rates low. It's not helping the economies much. Japanese stock market has been up over the last few years, but Japanese economy is completely flat. No, stock market's up very much because of central bank intervention. That's my view.
Bob, thank you very much. Really appreciate it.